Okay, let's get started. So welcome everyone. Great to see a few familiar names here. We've got people still trickling in, but welcome. So we're going to talk about income trading using Iron Condors today. If you've got any questions along the way, drop them into the webinar chat, just if you can change from hosts and panelists to everyone. That way everyone will see the questions that are being asked. And for the benefit of the people watching the replay, I'll read out each question as we go. Quite a few people on today, so we're likely to have quite a few questions. I will try and answer them as we go, but if we start getting bogged down a little bit and I don't get to your question, please email me afterwards, and then we can chat further on whatever question you had. All right, so just before we start, a quick disclaimer that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. Okay, so plan for today, we're going to talk a little bit about Iron Condor theory. We're going to discuss how to choose our strike prices. We're going to go into adjustment techniques and some trade examples as well. So quite a bit to cover. Hopefully you're focused and ready to go. So what is an Iron Condor? Well, here's an example. Most of you, I'd say, are pretty familiar. We've got some people who've been trading condors for 5 or 6 years, so pretty familiar with a condor is. Some of this stuff will be kind of reviewed pretty basic for you, but for others who are newer, might be new information, but we'll get to some more good stuff later on. So basically what we're looking at here is a January condor on LLY. Short puts are at 510, the long put is at 500, and then the short call's at 680, the long call's at 690. So at 10 points wide, we've got a couple of contracts, and we've got the 11 delta in the puts, the short put, and the 13 delta in the short call. Now we'll get to a lot of this setup shortly, but that's a pretty standard setup, particularly for me, around that sort of 12 to 15 delta for my short strikes. Overall, we want to have the position delta, which is this column here, close to zero. So we want to be sort of delta neutral. We've got 3 different columns here. Don't worry too much about delta dollars for now. We might get to that later. But the first delta column here is just the delta of the strike. And then this one is the position delta, which is basically this number times the contracts. So -2 times -0.11 times 100 gives us 22. And then we sum the 4 of those up, gives us our overall position delta. I don't usually look at these numbers here. I'm just looking at the overall sum and want this to be fairly close to 0. This is our profit and loss graph. So the blue line is the profit or loss at expiration. So we follow that. As you can see, we're risking about $1,650, and profit potential is about $350, $360, provided LLY stays in this range between 510 and 680. The purple line is what we call our T+0 line. So this is very, very important. We always want to look at this. T+0 basically just means how does the trade look as of today? So trade date +0 is kind of what that stands for. And I like to give a bit of an analogy that we want to be standing on top of the hill, or we want to have a ball and we want to be on top of the hill. We don't want the ball to start rolling down the hill, because once we start rolling down the hill and we get past this point here, the ball starts to roll a bit quicker. And we might be sitting on a little small loss here. All of a sudden, a similar sort of move, and the loss starts to get bigger and bigger as we go. So we definitely want to try to avoid that situation. So we'll talk a bit about trade management later on in the webinar, but basically what I like to do is set price alerts. So I kind of follow the T+0 line along to a level about here before the loss starts to get too big, before we start to roll off the hill. And I'm going to set a price alert at about 550. If that alert goes off, or if the price of 550 gets touched, I'm going to look to either close or adjust the trade. And I'm going to do the same on the upside. Again, I'm going to follow that T+0 line. Probably about 630 is where I'm going to set a price alert, and that's going to be my adjustment level. I can pretty much leave this trade alone, and as long as those price alerts don't go off, I know the trade's going to be more or less okay. I'm not going to be down too much. So I don't really need to monitor it every day, as long as those price alerts aren't going off. What you really don't want to let happen is get into a situation where you end up down here and we're at 660 or 670. It's very, very hard to adjust a condor from there. Whereas if we're at 630, we can easily do an adjustment there and potentially salvage the trade. Much, much harder if it gets all the way up to 670. And that's a mistake a lot of beginners make, is they'll watch the stock rallying. It's getting up here to 670 and they'll say to themselves, well, my short strike's at 680. As long as it stays at 670, I'm going to be fine. And then all of a sudden it's up here at 710, 720. And that's when you're in really big trouble. And there's really nothing you can do to salvage the trade then. So that's why I kind of set those price alerts before we start rolling too far down the hill. So the idea with Iron Condors is, generally speaking, stocks are going to stay within a 1 or 2 standard deviation range. You don't need to worry too much about how that's all calculated. You can look it up if you want, but basically around 68% of the time, the stocks are going to stay within a 1% standard deviation, and about 95% of the time, it's going to stay within a 2 standard deviation move. So that's the general idea with Iron Condors, is that most of the time we're going to stay in this area. It's a high probability trade. Now, the stock market's not perfectly distributed like this. This is what's called a normal distribution. In the stock market, we have what's called fat tails, where we do get these 2 and 3 standard deviation moves a bit more often than what's indicated by the normal distribution. So we do need to be aware of that and be careful with things like that. But the general idea is that most of the times they're going to stay within a 2 standard deviation range. So how do we select Iron Condor strikes? Well, there's 3 main considerations when we're choosing our strikes. That's going to be where to place them, what level, what price, how wide to enter the spreads. That could be 10 points, 20 points, could be 5 points, and which expiration month to choose. So we'll go through a few factors that we like to look at when deciding our strikes. So when we're choosing the level of our short strikes, the most common method is to use delta, as we talked about, sort of selling a 10 or a 15 delta, what we'd call a 10 or 15 delta condor. Now on that image before, we saw the delta was something like 0.11 or 0.13. We kind of just shorthand say that's an 11 delta or a 13 delta. We don't want to say 0.13 delta. So that's what we mean when we say a 10 or a 15 or a 13 delta. That's kind of where we want to put our short strikes. That's the most common way. Number 2 is we can use technical analysis. So we might be looking at a chart and looking for support and resistance levels or moving averages. And we might want to try and place our short strikes above resistance or below support, or above or below a key moving average that we think the stock might struggle to break through that level. And the third method is using standard deviation, probably a bit less common, but those are kind of the 3 methods. And using a combination of all 3 makes sense, but you also don't want to overcomplicate things. So some traders will just sell a 15 delta Iron Condor no matter what, and there's absolutely nothing wrong with that. That's kind of the way I do things. And then there's usually, if there's some support or resistance before those strikes, that's a bit of an added bonus, right? So using delta is the most common method, as I said. So here we've got an example with Apple for January. Again, we're looking at slightly different deltas for the puts and the calls. We've got a 16 delta for the short put and about a 12.5 delta for the short call. Overall, that's more or less delta neutral, slightly negative delta. Part of the reason why we're choosing different strikes here is because of this skew. I won't get into that too much now. We might touch on that later. But sometimes we see a little bit of a skew with stock like this, where the implied volatility on these strikes here, the puts, is at about 20 to 22%, and the implied volatility on the calls is about 15%. So I could probably do a whole class on implied volatility, but basically the IV of the stock is about 16.63, but then each individual strike will also have its own level of IV. So we've got about 21, 22% on the puts and about 15% on the call. So there's a little bit of put call skew there. But again, that's a pretty standard sort of setup. And then we have our payoff diagram. The trade's risking about $820 with the potential to make about 180. You can always calculate that risk pretty quickly, because we take the difference in the strikes, so 5 points wide, times 2 contracts, times 100 is about 1,000. Well, it is 1,000. And then we subtract the premium received. So we'll receive about $180 for making this Iron Condor trade. Therefore, our risk is 1,000 less 180 equals 820. Again, we've got our ball pretty much sitting on top of that hill. With this example, I'd probably set price alerts down here at about 182 and on the upside, about 195, 196. Always before we get too close to this short strike, before the ball rolls too far down the hill and it becomes much harder to adjust. What if we take a slightly different approach and sell roughly 25 delta strikes? We get a slightly different looking trade, and the risk reward of the trade and management of the trade will be quite different. So you can see here, roughly 25 delta on the short put and about a 22.5 delta on the short calls. So our strikes are much closer. Our overall position delta is pretty similar, slightly negative. Vega's a little bit higher, theta's about the same. But when we look at our risk graph, we're generating a lot more profit, a profit potential, $340, and it's risking about $660. So we're risking less, potential to make more, but the trade-off is we're much narrower. So some people may prefer this, and definitely this trade's going to do better if Apple stays flat. But you might find that if Apple does make a 2, 3, 4% move, we're going to be getting towards those short strikes a lot quicker than we would on the 15 delta condor. So not saying one's better than the other, they're just kind of different. I'm pretty comfortable with the 15 delta. That's what I've been doing for a long time. Other people may prefer the 25 delta, and that's totally fine. So pro tip for you, an unbalanced Iron Condor can be a good way to trade a trending market. So when the market has a strong rally, some traders get burnt on the call side. And that's actually a pretty common thing that happens. Most people, when they find out about condors, they're like, oh, what if there's a flash crash? And, I've got to worry about the puts. And in fact, I'd say more often than not, people actually get into trouble on the call side when the market just grinds higher. So here's an example where we've got the same strikes as those initial trades, 16 delta, 12.5 delta, but we're just doing one contract on the calls instead of the two contracts. Overall, we get a slightly positive delta. So positive 5 delta. We've got less Vega, so less Vega risk, slightly less theta, but not too much. And then we get a bit of a different risk graph as well. So you can see we've got less risk on the upside than we do on the downside because we're only trading one contract here. We're still generating 140, 150 over 850, 860, and we've still got a nice profit potential. What's that? 150 over 850 is about 17.5% return potential. And we're going to handle an up move much better. So I think we talked about setting our alert at about 196. The trade's not even really down anything at that point. So much, much easier to handle an up move when you trade an unbalanced condor. You could also do the opposite. If we're in a bear market, you could trade more call spreads than put spreads and have the less risk on the downside if the market starts dropping. So unbalanced condors are a really nice variation to trade if the market's trending. You don't always have to be completely neutral. Some traders also like to use technical analysis when choosing strikes. As I mentioned, placing call spreads above resistance and put spreads below support can be a great idea. Keep an eye on moving averages as well, as these can often provide support or resistance. So how wide? Well, it depends on the instrument being traded. So if we're doing a Russell Iron Condor, might be 10 or 20 points wide, whereas Apple might be 5 points wide. Wider spreads mean you're trading less contracts, but you're going to have more capital at risk. So that might be advantageous if commission costs are a big factor. For example, if you're a bigger trader with a larger account, you may prefer to trade wider contracts that have less commissions. So you're trading a bit bigger and less commission costs. Whereas if you're a smaller trader or if you're a complete beginner, you could potentially even take an SPY Condor and just do 1 or 2 points wide. You're not going to really generate a lot of return, but you're also not going to be risking much. And that can be a really nice way to just get familiar with how the mechanics work of actually placing the trades and monitoring them, watching them, setting price alerts, things like that. So it really depends. It depends on the underlying, and it depends on where you're at in your trading journey as well. How many days to expiration? This is a really common question that comes up quite often. I'd say the most common type is a monthly trade, so about 30 days to expiration. Some people prefer to trade a 60-day condor, and some people will swear by weekly condors. The main thing you need to know is that shorter term trades will fluctuate more quickly and will require more trade management. With longer term trades, traders do not need to react as quickly. So the thing I kind of tell people is weekly condors are fine, but they're not for everybody. They're not for me. They take too much time. It's too hard for me with the time difference. So I prefer 60, even sometimes 75, 90-day condors. If you've got the time to sit there watching the trades and react quickly, you can definitely do weekly condors. You're going to generate a higher annualized return when things are going well, but you've got to be pretty quick to be able to adjust. You don't want to be, if you're working full time, you've got this weekly condor, you're stuck in a meeting for a few hours, you come back and then all of a sudden the stock's made a 5% move and it's completely blown through your short strike. So you don't want to have that sort of scenario. The other thing I like about longer term trades is they move a lot slower. So if you think about that T+0 line that we were looking at before, with a weekly condor, that hill is very steep. So it doesn't take long before that ball starts to really roll down the hill. Whereas with the longer term condor, that T+0 line or the hill is really flat. So we can have a 2, 3, 4% move and it might not roll off the hill too much. Whereas with a weekly condor, a 2, 3, 4% move, you're going to be really rolling down that hill pretty fast. So basically the same thing. Further out in time you go, the slower the trade will progress. 3 to 4% move in the underlying. Might need to adjust a monthly condor, but an 80 to 90-day condor might still be okay. And weekly condors are going to move very, very quickly and leave very little chance to adjust. So adjusting, that's another massive topic that we always get a lot of questions on. So by far the thing beginners find most difficult is adjusting. Entering a trade is the easy part. What you do next is where, with knowledge, skill, and experience, you can gain an edge on other traders. We'll look at a few standard adjustments and how and why they can be done, and then we can look at some advanced methods. So we'll look at those in just a second. But I kind of touched on this earlier. This is kind of a rookie mistake that I see a lot of people making. They get into trouble by leaving their condors too late to adjust. So I've had many emails saying, my short strike's at 190 and Apple's at 188. What should I do? And at that point, it's kind of too late. You've got to really do something about it before then. Other than hoping and praying, which is not a good long-term strategy, right? So always set those price alerts before you start to roll too far down the hill, and don't leave it until the stock is right near the short strike. And absolutely rule number one is do not ever let it get through the short strike, because then it's even harder to get out of things and to try to salvage it. So never, ever let the stock get through the short strike. At worst, preferably, you're adjusting well before it gets to that short strike. All right, so let's put some of this theory into practice, and we'll go and look at a couple of examples. So first we'll look at the Apple example that I had set up in the slides. So this is going out to January. This is the unbalanced version of the Condor. Hopefully everyone can see that okay. Just going to try and zoom in a little bit. Now this is my broker account, Interactive Brokers, and a platform called Risk Navigator. So if you're with Interactive Brokers, this might be familiar to you. If you're new to IB, it might not be. I've got some tutorials on how to use it. If you're using a different broker, you might have something similar. For example, Thinkorswim has something called the Analyze tab. Basically, all you want to be able to see is your Greeks and your payoff graphs. That's the main thing we want to see. I'll add a T+0 line, and we can see that purple line comes in there. Remember, our purple line is how does it look as of today. Blue line is how does it look at expiration. We can even put in a custom date and say, right, how does it look at the end of the month? And you can see there, we're going to be in a slight profit. Anywhere between about 186 and 197 is looking pretty good. Yep, you can still use TradeStation. They're pretty good. I'm not sure what their platform's called, but you should be able to find something similar to this. And the T+0 line is just the trade date plus 0 days. So how does the trade look as of today? And then here we've changed it to I think it was roughly a T plus 14. I didn't want that one. So yeah, roughly T plus 2 weeks. Trade date plus 2 weeks. T plus 14. And then we can just change that back to a T plus 0. And that's the unbalanced version. If we were going to do the full Iron Condor, we'd have the 2 contracts there. Now we're all even on both sides. We've generated a little bit of extra premium and we're looking pretty good. All right, so anytime I'm doing a trade, I'm going to always look at it in Risk Navigator first. Just make sure everything looks okay. I'm going to look at my price alerts. Then in terms of entering the trade, it is going to be different for every broker, but with interactive brokers, we put in the stock, we go to combinations, option combos. And another common question that comes up is, do you enter it as one trade or 2 vertical spread trades? I prefer to do it as 2 vertical spread trades. So rather than doing an Iron Condor, I'm going to go here to vertical spread, choose my expiration date. I'll do the puts first. Now IB is a bit backwards. We kind of have to do it, put the closest strike first. Sorry, that way. Select, and I'll add that one, and then I'll do the calls, which was 205 and 210. So then we get our 2 spreads, we've got the underlying strikes, and I'll usually just sort of separate these out. Now, unfortunately, because we're after hours, we're not getting prices coming in for these spreads, but normally you'd see a bid price, an ask price, and a mid price. What we want to do is click on the bid because we want to sell that spread. So we're selling the call spread, even though it says bull call. Interactive brokers is a little bit confusing, but we want to basically sell that call spread, and then we want to trade it somewhere near the mid price. We can kind of, as I said, during market hours, this will be populated and we'd have a mid price there that we could then put into here as our price. We can calculate that pretty quickly. Basically, the difference between these two, we're selling for 101, buying for 47. Difference is about 54. So the midpoint's going to be about 54. So I'll do that, and then I'll do the same for the put side, selling. What's the difference? A bit under 43 cents, is it? So 0.43. And then, you could do 1 contract or 2 contracts in the example, and then that gets filled. So that's the way I kind of enter them. Then when we need to do any sort of adjustment, we'd basically come in and do the opposite. Let's say this has been filled. We wait a week or so, all of a sudden we need to adjust. We'd come in and we'd buy to close. We'd do the same thing, close it out at the midpoint, and then we'd maybe roll it down to lower strikes, and then we'd sell the newer one. I just like 2 contracts because it's $1,000 at risk. It's kind of an easy example to show people. So once those first opening trades have been filled, I just have to remind myself of my alert points. I think it was, I'd say about 182 and 196, I think it was. So you can do this a few different ways. There's apps. I just do it within interactive brokers, but we can go on the stock. We can right click and click this little bell to create a new alert. And I'll say if it goes below 182, and what I also do is just an advanced setting, next, finish, and I'll put it active until the expiration date so that when the Iron Condor expires or I've closed it out, the alert dies with it. So I'm not left with a whole bunch of alerts for trades that are no longer active. So I'll show you that again. Again, not as relevant if you're not using interactive brokers, but there might be something similar in the broker that you're using, or you can use a different app or website for price alerts. So on the upside, I think we said 196. So if it's greater than 1 or equal to 196. Again, we don't need to worry about this. Active until January 19, 2024. And then we're basically done. And like I said, we don't have to watch this trade unless those alerts get filled or get taken out. Sorry, a question here, why I'm doing 2 spreads instead of 1 full trade. Yeah, it's just a bit easier to get filled, as John said. Yep. So Apple's not too bad because it's quite liquid. So you can see here the bid and the ask price are quite close together. There's not a lot of spread. So Apple, you probably could get filled as a 1 trade, but I just find it easier to do 2 separate trades. With an underlying that has a wider bid-ask spread, it would be harder to get filled as 1 trade. It'd be a bit easier to get filled on the 2 spread trades. And then once one gets filled, you want to pretty quickly get filled on the other one. Now, you can leg into trades as well. If you think Apple's, really oversold or due for a bounce, you might trade the put spread first, wait a day or two, the stock rallies up, and then you sell the call spread. You can certainly do that. Obviously, it could go wrong sometimes where you only do the put spread and then Apple drops. And then you're like, oh, should have done the call spread as well. Question here, are the alert points based on a certain delta or maybe a number of strikes? No, not really. It's really based off that T+0 line. So I would just want to not roll too far down the hill. For example, one thing I do, if I'm just doing a simple credit spread, if I'm just doing the one side, this doesn't work with Condors, but I might look at the credit that's being received, let's say $90. I follow the T+0 line till the loss is about equal. And that comes in at about that same level, 182, 183. So no, it's not really based on the delta, but there is something else that I will watch in terms of trade management, which is these 2 numbers here, our short delta. If we're starting at a 15 delta, if these get to 25, that's sort of when you want to adjust as well. Now that's going to tie in pretty closely with those alert points that we're doing with the price alerts, just from past experience. So I don't have to watch this too closely because those price alerts are kind of going to take care of that. And usually if that price alert goes off, say on the downside, this delta is going to be pretty close to about 25 and need adjusting anyway. That's just kind of the way I do things. Other people may have different ways of doing it, but hopefully that helps you a little bit, gives you some ideas. All right, let's look at another example. As I was saying, for people who are brand new, you could potentially do something like this. Now, this is a December expiration. This is a very small little trade. All we're doing here, similar idea, about a 13 delta. We just got the 1 contract and we're just $2 wide. So like I said, we're not really generating a lot of money, but we're not risking much either. So you could do an Iron Condor trade that's only risking a couple of $100 just to get a feel for like the trade entry and how things move. Paper trading's great, and I definitely recommend that if you're new, but sometimes you have to actually have real skin in the game to actually learn stuff, right? I find paper trading can be a bit, it's not real, right? Whereas if you actually got, even though it's only a couple of $100, you've got a bit of real money on the line, you tend to watch it a bit more and pay a bit more attention and take it a bit more seriously. So, that's something you could do. The other thing I want to show you is, we'll go back to Apple. I'm going to try and keep this scale the same. What we're going to look at is, might take this off. We're just going to look at the T+0 line, and we're going to compare it to a weekly condor. And you'll see the difference in the steepness of the hill that I was talking about earlier. So let's use next week. Try and use roughly the same delta. Now we've got a 10 or a 17, so I'll go with a 17. That's closest to the 14. Those will be our short puts. Those will be our long puts. So 185, 180. And then on the upside, we've got 15 delta, 195, and 200. So let's try and zoom in here from sort of 150 to 230, and let's see how that looks. So let's now just take a screenshot of that. So that's our January Condor. That's our long-term one, 60 odd days. And then if we switch that to short-term, weekly, we're still risking the same amount. It's 5 points wide, 2 contracts. Look at how much steeper that is. If the stock goes to say 180, we're down about $450. Whereas with this one, if the stock goes to 180, we're down about 50. So see how that's a much flatter hill? I prefer this. I don't like this. This is very, very steep. So that's just one thing I just wanted to sort of show you. Like I said, nothing wrong with doing this if you're able to manage it and you can handle the risk. But I personally prefer this style. Now, profits are going to accrue slower, but losses are going to accrue slower as well. Look at that difference in the theta, $14 a day in time decay. Lots and lots of time decay, whereas we're only getting $3 a day here. But I'll take this any day of the week. Slower moving trade, less risk. All right, let's look at another example. So the other one from the slides was LLY. Don't know if the stock moved much today. Yeah, it was pretty flat, so that's good. So our strikes should be pretty similar. I think we used a 5, what might have been a 10 delta, or roughly 11 delta for the puts. And then on the call side, I think we had a 680, but I might just use a 11 delta as well because it's the same. So they might be slightly different to the ones we looked at in the slides, but we're 10 points wide here. So if I just do the one contract, we're still going to be risking that $1,000. And there we can see generating about 160, risk is about 840, nice flat T plus 0 line. You know, alert points are going to come in about here, somewhere between 550 and 560, depending on, you know, whether you want to be a bit more conservative, you might do 560. 550 is pretty good, or even 555, somewhere around that level. And then on the upside, you know, that's about a $50, $60 loss. Similar level up here is about 640, 635 would be the price alerts. Now, we talked a little bit about delta dollars earlier. I'm going to just try and think of the best way to explain this because I do watch this number as well. Basically, all it is our position delta times the stock price. So there's a bit of rounding going on here. So our position delta is not going to be exactly 0. It's probably going to be about 0.4 or something like that. 0.4 times the price of 588 is going to give us roughly that 210. And if I change the contract size here, we might see that a little better. So yeah, we can see our delta's 4. 4 times 588 is 2352. So there's a little bit of rounding. So it's probably like 3.7 or something like that. Let's see. Anyway, we're going off a bit off track here, but just want to explain that number. So yeah, 3.6. I was pretty close. So 36 times 588 is going to give us that delta dollars number. If we go back to our original number of contracts, it's going to be 0.36 times that is our delta dollars. That's important. Well, I find it important anyway because it tells us our notional exposure. So right now we've roughly got $210 long in LLY stock, pretty much neutral. There's really no exposure. If this number gets up to about 2 or 3 times the capital at risk, so we're risking about 850. If it gets to about 1700 or 2500, that's a bit of a warning sign for me as well. So that's another thing that I'll watch. That could be plus or minus. So if the stock drops down, we're going to have positive delta dollars. If it goes up, we're going to have negative delta dollars. If you need a bit more information on that, just shoot me an email afterwards. I won't probably go into that in too much detail. It's a bit more advanced, but that's another little thing that I watch. Good question here in terms of trade management. So I'll usually take a 50% profit if it occurs in less than 50% of the time. So we're generating about 160 here. We've got about 2 months to go. If the trade's up about $80 within the first month, I'll close it out. Another good rule is to not let it go too close to expiration. So I might start to look to wind this down when there's about 2 or 3 weeks to go in the trade. Because, you know, if we hold this trade all the way to expiration, it basically becomes a weekly trade because we're holding it for that last week. Now, if it's right in the middle here, I might make an exception because it's quite wide and there's probably very little risk. But if it's, up here, starting to get a bit, skewed to the upside with risk, I'll look to exit early. Generally not going to be taking them all the way to expiration. And then a good rule of thumb for a stop loss is about 1.5 times capital at risk. So if it gets to, 160, if it gets to about a $200, $240 loss, even if we've been trying to adjust it, I might just cut losses then and close out. We don't want to let that loss blow out to $400, $500. So that's really important with condors. You're going to have losing trades. You want to just make sure you try and keep those losses fairly small. Any questions on what we've discussed so far? Question here, when you have a spread and the underlying stock has gone past your short strike, can you simply close the short strike and keep the long strike? You can. I don't like doing that. I prefer to adjust well before it gets to the short strike. You're exposing yourself to a little bit of risk by just keeping that long. Let's say the market's rallied up and it's up here at 685. What you're saying is you close out, these puts will basically be worthless. You close this one out and you're just left with this long call. But then if the stock drops back down, you're going to take a big loss on the long call. So no, I don't like doing that. I know some people will do that, but it's not my preferred method. Is the profit target based on the initial credit? Yep. So 50% of the profit potential in less than 50% of the time is kind of the first profit taking rule. So we're generating 160 here. So if the profit's 80% in less, not 80%, $80 in less than a month, that'll be a closeout rule. And the stop loss here about 1.5 times the premium. A few questions here on adjusting and defending. So yeah, we'll get to that next. Yeah, good question. What are types of stocks to avoid when doing Iron Condors? So that brings up an interesting point about implied volatility. And as I said, we could spend a whole session on implied volatility, but what you want to be looking for is a stock with high IV, a high IV percentile. So there's a difference between high IV and high IV percentile. So a stock like Tesla will have high implied volatility. But what IV percentile is here we're looking at a chart. The gray line is the stock price. The white line is the IV. So IV is at about 28%. It's maybe middle of the range, maybe slightly higher than the midpoint. So it's probably got an IV percentile of about 60%. So it means that 60% of the time in the last 12 months, the IV has been lower than what it is now. So that's potentially a good time to sell an Iron Condor. That's why this one came up. Whereas if we look at Tesla, it's got much higher IV. So the IV is 45%, not 28%, but it's actually got a low IV percentile. So compared to the last year, implied volatility is actually pretty low for Tesla. So we tend to want to focus on stocks that have a high IV percentile, not necessarily a high IV. So there's a little bit of a difference there. If that's confusing, just let me know. We can chat afterwards. You can think of implied volatility a bit like a stock. You want to buy low and sell high, or in the case of a condo, you want to sell high and buy back lower. So other stocks to avoid, anything that's high risk, anything that could move 10, 15% in a day is sort of best to avoid. You want to focus on stocks with high liquidity, so good bid-ask spreads. The top 10, your Microsoft, Tesla, Apple, and then ETFs like index ETFs, SPY, QQQ, IWM, all going to have pretty good liquidity. Yeah, so we're comparing the current level of IV with the past history. So IV, when it's up here at 90%, can be a good time to sell a condor. Options are very expensive, so it's a good time to sell them. Whereas right now, options are very cheap, so it's not a good time to be selling, relatively speaking. So the relative value of selling options right now in Tesla is not as good as it was back here when it was at 65%. And yeah, you want to be looking at the technicals as well, because you might think a stock's going to be a little bit range bound. That's the price is going to be the main driver, and volatility is going to be kind of the second driver. So having a stock that is going to stay within a particular range is kind of the first and foremost most important thing, and then the volatility is kind of a secondary consideration. Yeah, you can potentially do the opposite of Iron Condors and buy options when volatility is low. So things like long straddles, long strangles, they're a bit harder because they lose money every day through time decay. Iron Condors over earnings, yeah, can be good. As long as you understand the risks that if it makes a bigger than expected move, you might suffer a full loss. Yes, we're going to talk about adjusting and defending. Yep. Just get through some of these other questions before we move on to that. Yeah, if there's a gap, obviously can be an issue. So if you're trading an individual stock, you may want to avoid earnings. So for example, I think what you're saying is, LLY, we've got our price alert at say 560. It might have some sort of bad news item that comes out and it opens up down here at 520 and it's blown right through our price alert. Unfortunately, that's just trading. There's not a lot of things you can do in that scenario. You've just got to, close out or try to adjust as best you can. And yeah, I sort of manage as I go. I don't like automated stop losses because of the bid-ask spread. That they just don't work very well with options. They work great with stocks, but not so much with options. How can you watch this chart? I assume the IV. So this is just within Interactive Brokers. Again, there might be some other places where you can get an IV chart, iVolatility, for example. What are the advantages of an Iron Condor over credit spread? So an Iron Condor is delta neutral. So you don't care about the price. You think the price is going to stay pretty flat, whereas the credit spread is quite directional. They can be a bit unforgiving if you get it wrong. Whereas with a Condor, if the price goes down, you're making money on the call spread because that's dropping in value and helping offset some of the loss on the put spread. Whereas if you just had the put spread and the stock goes down, you're just going to be losing money on that. There's no sort of offset. The other advantage is you're generating extra premium without adding any extra risk. And in fact, the risk reduces a little bit because of the premium. So if we did just the put spread, generating 100 over 900, 11% potential return, that's pretty good. But if we add the call spread, our risk goes down by about $60 and we're generating an extra $60 in credit. So our return potential is higher. What's the advantage of Iron Condors over other strategies? So they're pretty high probability. So selling a roughly 10 delta Condor, roughly going to be 90% success rate. So 90% of the time we're going to stay above that 10 delta strike. They're pretty slow moving. If you're trading the longer term ones, you're not having to worry about price, so you don't have to pick direction, positive time decay. So yeah, definitely a few advantages. They're not going to work in every scenario. There's going to be some market conditions that are better for Condors and some market conditions that are better for other strategies. But certainly when the market's a bit flat and it's just bouncing around up and down and not making these big moves that we've had in the last few weeks, then Condors will do really well. It's also another advantage is you're selling volatility. Generally, volatility is overpriced because people are willing to pay. It's like paying for insurance. So people are willing to pay for insurance to protect their portfolio. You can think of selling options as almost selling that insurance to people. So it's a good kind of business model. Philip says, yeah, Juicy, watch this yet? Tesla, Netflix, AMD, Amazon, Nvidia, Google, Microsoft, Meta, Adobe, and Apple. Yep. So those are probably, some of the biggest and best. Yep. And then ETFs, like I said, SPY, QQQ, IWM. All right. Cool. Good questions. So let's talk through an adjustment or a defense example. So here I've got an example on Netflix. It's rallied up quite a lot recently. Now, normally we'd want to adjust before it gets to a 32 delta. We'd want to adjust when it gets to about a 25 delta, but it's made quite a big move. So what we want to do in this scenario, there's a few different adjustments you can make. There's lots of different adjustments, but I'll talk through sort of the most basic ones. I like to think of them in terms of playing defense or attacking. So playing defense generally is going to mean we're reducing risk, but also reducing the profit potential. If we're making an attacking adjustment, we're going to be increasing risk, but increasing profit potential. The two kind of go hand in hand. In this scenario, I'd be looking to play defense because we're getting quite close to this short strike. We've gone through our price alert. We're starting to roll down the hill. What I would do is I'd buy back the call spread. So I'd close that out. I'd set up that 485, 590 call spread. I'd sell to close. And then I would sell a new call spread a little bit further up. This is December. Let's say 495, 500. So we'd buy back that one and then we'd sell this one. And you can see now we've got a bit more margin for error on the upside. We haven't completely fixed the trade. We've still got a high delta dollars compared to our capital at risk. We're still around a delta 23, so it's not ideal. But this one's kind of been left a little bit too late to adjust because Netflix has made such big moves. But that's sort of the first thing I would do. So that's our initial trade. You can see at the moment there's $300 in premium remaining in the trade. When we close that out and roll to the new one, we've only got about $200 in premium remaining. So it's effectively cost us about $100 to make that adjustment. And you can kind of work that out. I was going to show you the maths. Some of you will probably already know this, but we're going to have to buy back the two spreads, and it's going to be 685 minus 547. It's actually going to be negative cash flow because we're going to have to buy that spread back. So that's what we're doing there. We're buying that spread back, the two spreads. It's going to cost about $276. Then we sell this spread, which is positive cash. We're going to get about $177 for selling that new spread. The net cash flow movement is about $100. And we saw that because the profit line dropped from 300 down to 200. So that's an example of a defensive adjustment. Now, instead of doing that, we might do an attacking adjustment. And we might say, I'm pretty sure Netflix is not going to go above 485, even though that's quite risky, in my opinion. Rather than defending the under pressure side, what we're going to do is we're going to roll up the untested side. So what we might do is we're going to buy that one back to start with, and then we might sell a new spread back at about that 15 delta. So we've got there the 435 puts are at a 16 delta, 5 points wide. We buy back this spread. That's only going to cost about $12, $24 for two contracts. And then we sell this spread. And that's what, about 60 odd, 65 cents times two contracts, that's about 130. So that's bringing in this case, we're bringing in $100 in premium. Now, one thing with IB, we have to just reset this T+0 line when we make an adjustment. So that's what I'd call an attacking adjustment. We've rolled the strikes in, so we've got less margin for error. We've got a narrower condor, but we've generated a bit of extra premium. We've actually, in some ways, reduced the risk. So some people may prefer this style, and it does depend on the scenario. For example, I'd probably go and look at a chart of Netflix, and I might say, where's 485? Is there any potential resistance? There is a bit of potential resistance at 485, but it's still pretty close. I'd probably still want to play a little bit of defense. But you might say to yourself, right, I think 485 is pretty safe. I'm going to roll the puts up. I'm going to generate a bit more premium. And we've actually reduced our delta dollars by more through doing that than we would have if we just rolled the calls. You can also do a combination. You can reposition the whole thing. So we might roll the calls up and we might roll the puts up. Bang, we've recentered the Condor and 300 profit potential remaining in the trade. The cost of rolling the calls out is about equivalent to the extra premium we got for rolling the puts up. Net, it's about zero. We've just kind of moved the whole thing up. So that's certainly something you can do as well. Those are kind of the two easiest adjustments. So defensive roll and an attacking roll. Now you can also do more advanced things. You can roll out in time. You can add a calendar spread or a butterfly, try to protect that short strike, but I probably won't go into that in too much detail. The other thing you can do is delta hedging. So let's say we keep our initial Condor as it was. Again, I'd probably still want to play a bit of defense here, but what we can do is look at that delta. We've got delta of -9. If we add a stock position of 9 shares, say we buy 9 shares of the underlying, we've neutralized our delta, we haven't impacted our theta, we've flattened that T+0 line, and now we're looking pretty good in between sort of 440 and 485. Very little risk on the upside now. So that's delta hedging. That's another nice little adjustment because it means you don't have to change your strikes. You also don't have to fully delta hedge. You might do like a 50% delta hedge just to help limit that upside a little bit, bring that delta dollars down a little bit. That's certainly something you can do. Now that does cost a bit of money. 5 shares times $400 is going to be about $2.5 grand to buy those shares. So you do need to have the capacity to do that. But that's certainly another adjustment option that you can do. Another little rule of thumb, if I'm within the last sort of 21 days, 3 weeks to expiration, I typically wouldn't do an attacking adjustment. I'm typically sort of playing defense in that sort of time frame. Where if it's early on in the trade, say this was a January trade and there's still 2 months to go, I'd be more likely to do that attacking adjustment. Because what I don't want to do as we get close to expiration, we're still about a month out, so it's probably okay. I don't want to do this attacking adjustment and then Netflix turns around and reverses down and now I'm under pressure here on the put side as well. That's the sort of scenario I really don't want to get into. And certainly not when we're getting close to expiration, because again, that T+0 line is very steep. If the market starts to reverse, we're going to roll down the hill on the put side. So that's another good little rule of thumb for you. Alrighty, any questions on adjustments? Adjustments is a big topic. We've got to spend 20 minutes or so. We could probably spend a whole session on adjustments. But if you've got any questions, pop them in the chat. Mark says, when will you use the delta hedge, i.e. buy sell shares? Yeah. Depends on the scenario. Again, I'm making a judgment call on this 485 strike. Is that going to hold, or is there a chance Netflix is going to get through that strike? So in this scenario, I'm probably going to first and foremost play defense and roll that out. I might use a delta hedge when we're getting closer to expiration because we will have really high theta. If we say play defense here and roll this out, we're going to impact our other Greeks. Theta hasn't actually dropped by too much, but delta hedging is good because it only affects the delta. It doesn't affect your theta or your vega. So yeah, delta hedging as we get sort of closer to expiration, I might just leave it like that. Maybe makes a little bit more sense. You might just be able to buy yourself a few days and be able to stay in the trade for a little bit longer and pick up a bit more time decay. And what I'll do in that case as well is I'll set a little price alert. Say I've got this delta hedge on. I'll readjust my price alert to maybe 450. And if Netflix drops back to 450, the delta hedge isn't really needed anymore. We're back sort of in the middle of the Condor. I'll sell those shares at a small loss. That's a bit of a cost for hedging. And then I'll try and get more time decay out of the underlying Condor. So that's kind of a little process that I'll do as well. So, even doing something like this, you could potentially do the defensive role on the calls and a delta hedge, but we're probably a little bit far out from expiration to be worrying about delta hedges. But yeah, I'd probably do that closer to expiration when we're getting high theta and we just want to try and neutralize that delta a little bit. How do I decide between a defensive adjustment versus closing the whole thing down? So if the loss is about 1.5 times the total premium, you would just close out. Yeah. All right. Any other questions on adjustments? Anyone want to look through another example? Yes, the meeting will be recorded. Yeah, we've gone through a lot. I know I kind of go through things a bit fast sometimes. So yeah, definitely recommend watching the replay and just going back over anything a second time. It'll sink in a bit more the second time. Yep, I'll send the replay out to everyone. What's a realistic annual return on your type trading? So I wouldn't trade 100% of my account with Iron Condors. I might do like 30% Condors. It really depends on how aggressive you're being, but if you're being fairly conservative, I think aiming for a 12 to 18% return is good. It's obviously going to be different for everybody. It's going to be different in different market environments. So it really does depend. I don't like to make any sort of promises about returns because it's different for everybody. It depends on your skill and your expertise in adjustments. Depends on the market environment. Some people will aim for 100% returns a year, right? They'll be trading weekly condors, massive return potential. But, finance 101, if we're aiming for a high return, we're obviously taking high risk. So the two go kind of hand in hand. Advantages of a calendar spread versus a vertical spread. Calendar spreads are positive vega, so they can be good if volatility is low. They'll benefit if volatility picks up. They can also take advantage of skew. So, around earnings, you can do things like that where the volatility is high in the front week and lower in the back weeks. But yeah, it's sort of a bit off topic. Do I have a place to look for volatility in specific stocks? Yeah, so I use bar chart. This is a paid product. I thankfully get it for free because I write for them, but I can't remember how much it is. It's probably one of the only paid tools that I recommend. So I have a bunch of stock screeners. I'll look for stocks with an IV percentile above 50 and good market cap. And a lot of these are going to be because they've got earnings coming up. But I think LLY was on here. They've already had earnings. They've got good volume and IV percentile 73%. So that was kind of how I found that one. You can do it in your broker account as well. I don't do it anymore. I used to have it all set up, but you can have Apple. You can have your watch list of stocks that we kind of talked about. I won't put them all in, but they've got a column here for IV percentile and IV rank, so you can kind of be scanning there as well. So usually your broker might have that information, particularly IB or Thinkorswim should definitely have that. What factors tell you to close a trade? Profit, timing, possible loss? Yeah, all of the above. So we kind of talked about profit target, 50% in 50% of the time. Stop loss, 1.5%. 1.5 times the premium, and timing. Within those last 21 to 14 days, I'm starting to look to generally wind that down. Yeah, 1.5 times loss. That's just kind of a rule of thumb that I'm happy with. Yeah. Would you decide between an Iron Condor and double diagonal simply based off IV? Yep. So both similar trades in that they're range-bound trades, double diagonal, but double diagonal's positive vega, so we'll benefit from a rise in volatility. So that might be better on a case where you've got a stock with a low IV percentile like Apple. This is going to benefit, the trade will benefit if implied volatility rises. So you can see here, Apple, very, very low volatility at the moment, the lowest we've seen in the last 12 months. So not really a good time to be selling condors on Apple. And Jack, as you sort of said, maybe that's better to look at a double diagonal if you have a neutral price outlook. So you can think about it. Let's do a little cheat sheet for you. I'm sure I've got one somewhere, but let's say price outlook, IV outlook, or IV percentile. So price outlook is neutral. IV percentile is low. And we'll go strategy, double diagonal. Price outlook's neutral, IV percentile's high. We would look at Iron Condor. I mean, we're only kind of looking at neutral trades, but that's, then you could do other ones. Price outlook bullish, IV's high would be a bull put spread. Outlook's bearish, IV's high, bear call spread. So you can come up with a little cheat sheet like this, right? Outlook bullish, IV's low, bull, we're going to double up here, bull call spread. Outlook's bearish, IV's low, bear put spread. It's a bull put spread, bear call spread. So you can come up with little things like that. Should have just written them out in the first place. So there you go. There's a little cheat sheet for you. Alrighty, that's about all I wanted to go through today. So if there's no other questions, we might leave it there. But happy to stick around for a bit longer if people have got questions, want to chat a bit further. Happy to do that. The session was recorded, so I'll get the replay out to everyone. Glad you picked up some info, John. Great. Thanks, Kyle, Abby, John, Jack, Mike, Philip, Warren, Ananda, Harry, Joseph, Christian. Thanks. Any tips on Excel to set up a sheet or anything to help with? Not that I can think of. I only use Excel. Oh, maybe you're talking about like a tracking sheet. Yeah, I've got a sample I could send around if you want to track your trades. Can we look at an example on Amazon? Yeah, sure. So we're right around the cutoff for starting new trades in December, 28 days. It's getting a little bit too short term. Personally, I'd probably go out to January. I want to just maybe double check the earnings dates as well, just to make sure we're not covering any earnings reports. 15 delta, perfect. 5 points wide. And on the calls, 15 deltas at a bit of a weird strike, but there's still plenty of volume there. The spreads are tight, so that's not so bad. We could potentially do that one, 161, as long as we can get a 166. Yep. That one's, sorry. Sell the two middle ones, buy the two outer ones. And there you go. Generating 200 over 800. Just double check this T+0 line. Alert points going to come in somewhere between 135, 137, somewhere around that zone. 135, 136, 137, whichever one you want is fine. On the upside, probably about 151, 152 would be the price alerts. If there's earnings, yeah, I'd probably look to go before earnings, yeah. Because we're not going to see a lot of decay in the lead up to earnings, time decay, and this volatility is going to rise as we go into earnings. That's bad for a short vega trade. So yeah, generally I'm going to want to try and avoid earnings unless it's a specific earnings trade. Do I have a minimum percentage return potential compared to dollars at risk? For a credit spread, I'll usually look at about 10, 11%. So Condor close to 20%. Let's just make sure all those examples. LLY is a little bit low. Oh no, sorry, that's only risking. That's close to 20%. Apple, about 20%. So yeah, 20% is pretty good. Yeah, good question about Warren says, if I have time, could you talk about buying a call instead of shares to delta hedge? If so, what strike? Yeah, so that's another thing you can do. Let's go back to our initial Condor for Netflix. So there's our initial one before we adjusted. So overall delta of -9. So if we were to buy a 9 delta Condor, it's going to work the same, or roughly the same as a delta hedge using shares. The only difference is we're going to impact all our other Greeks as well. So there's a roughly 9 delta. So if we buy one of those, you can see there we've still got profit potential. We've got massive upside gain potential if it does make a huge move. So that's one advantage of doing it that way. Whereas if we buy the shares, we're not really getting that upside potential. So yeah, that's something you can do. Another thing you could do is place a debit spread in front of the credit spread. Again, we're getting a little bit off topic here and a bit more advanced, but I'll just show you quickly. Maybe you're a bit more advanced than some of the others here. Our short strike's at 485, so we could say buy that one. So we might buy this debit spread. So we'd buy one here, sell one here, which becomes -3. So you can do something like that as well. Cuts down the delta. But yeah, if you're new, don't worry too much about that. And Warren, if you want to discuss that more, let's email, chat offline. Okay, I see John raised a hand. If you've got a question, just maybe if you could type it into the chat, or if it's something else, just maybe shoot me an email afterwards there, John. Yeah, just email afterwards. If you've got any further questions, shoot me an email afterwards and we can discuss. Cool. So as some of you know, I've opened up my accelerator program. So that's closing tomorrow. So some of you may have received the emails. This is a 12-month program. So we've got a few modules. These are all pre-recorded. So we've got Condors. Trapdoors, a variation on the Condor. I wanted to kind of go through that briefly today, but didn't really get time. Diagonals, bearish butterflies, the wheel, strangles, module on technical analysis, psychology, all about volatility. We kind of touched on that in a few points today. It goes into volatility in a lot more detail, some quick tips for you. Gamma scalping, again, is a bit more of an advanced strategy. But these are all pre-recorded, so you can go through these in your own time. Then every week we have a live webinar, kind of similar today, but the general structure is we kind of look at the overall structure of the market. We talk about what the indexes are doing. We sort of bullish, bearish. That's sort of a 5-10 minute discussion. Then we'll go into between 5 and 10 trade examples that we're going to look at for the next week or two. We'll kind of go through the setup, why we're looking at that trade, how we would put it on, how we would manage it. And then after we've gone through those 5 to 10 trades, new trades, we then go through any existing trades. We talk about, what's happening with the trade. Is it under pressure? Have our price alerts been hit? Do we need to adjust it? And then we talk through how we would adjust it. So have a look at that. There's some bonuses there as well. You can have a look through this in your own time. But yeah, it's a 12-month program, $997 US. We've got a Discord chat room as well, which I'll show you. But basically, within the course, we've got all our modules here that I just sort of went through. So you'll get access to all this straight away. Like I said, these are all pre-recorded. You can go through these in your own time. Got bonuses there. And then all of our case studies, I used to archive them on the website. I now do everything in Discord, which I'll show you. Weekly sessions going back to 2017. So we've been meeting for a long time. And then here are all the recent weekly sessions with all the example trades. And then the most recent replays there. And then here's our chat room. Lots of different trade channels. We've got a good couple of hundred members here now, 300 odd members. And then got our weekly case studies channel where we're sort of talking about all our examples. If I scroll up, I'll kind of do everything. I'll put the date and then I'll put all the examples that we're looking at. I'll always put sort of new at the front. And anytime we're adjusting or closing, I'll put adjust. That one expired. That one's a close, profit take. And then you can kind of click back on the link above to see the original trade if you want to go back to it. And then a bit of chat in the general as well. If you've got any questions on that, just let me know. But that is closing tomorrow. Won't be open again until sometime next year. You can check out reviews here on Trustpilot. 94% 5-star reviews. So yeah, if you've got any questions on that, like I said, closing tomorrow. Can you trade recommendation for day trades, swing trades, and longer term trades? So we do mostly sort of medium term. There is some people in the group who are a bit more risk tolerant than me, and we've got a lot of chat that goes on here in the 0 day. Hasn't been much for a little while actually, but a lot of people doing 0 day trades and shorter term trades. A lot of chat going on here. These are kind of, it's under the wheel, but a lot of people are talking about credit spreads as well. But there's a lot of stuff going on there. Most common strategies would be condors, credit spreads, the trapdoor, which as I said is the variation on the condor, and the rhino. We've been doing a lot of the rhino trades lately, and then wheel trades as well. So some of you may know what the wheels are. The wheel trade is. So yeah, a lot of people will do the exact trades. A lot of people will just use them for ideas. And then kind of the idea is it's not really trade alerts. So I'm not sending out alerts, this trade needs to be adjusted now. We're kind of just looking at everything after hours and, this is what's happened. This is how I'd handle it. A lot of people will do the trades themselves, but the idea is that, you go through the modules, you come to the weekly sessions, and then after a few months, you start to become a bit more self-sufficient and you start to then be able to place the trades and adjust the trades on your own. And then you can kind of ask questions here if you need any help. You can share ideas. The main idea is to help you become self-sufficient. Like, I don't want people relying on me for trades, right? And some people will. Some people have been with me for a couple of years and they love doing all the trades that I look at each week. But the idea is for you to become self-sufficient. And that's awesome. Like there's an ongoing yearly fee of $4.97 if you want to stay in for longer than a year. A lot of people will just stay for the year. They'll learn how to do things, then they'll go off on their own, and that's great. Other people like the community, they like the ideas every week, so they'll stay on. You don't have to stay on for a second year. You'll learn everything you need to know in the first year. But some people do like to stay on. Don't have any trial periods, sorry. Don't do trials. But there is a 30-day refund period if you join and it's not what you expected. You're not happy for whatever reason, just let me know and I'll refund you straight away. That's no problem. So that's the address there. Options trading, imqmentoring.com. I'll drop that in the chat. So yeah, any questions on that? Yeah, let me know. It's a really good group. Sometimes you join these group and there's just a bunch of people talking nonsense in there. There's no annoying people, shall we say, in here. Everyone's really helpful, really friendly, sharing ideas, encouraging each other. There was someone the other day who had an issue with Think or Swim, and I am somewhat familiar with Think or Swim, but I couldn't kind of help him because I wasn't sure exactly how to do what he was looking to do. And then where was it? Yeah, so Dave saying, go here, portfolio and simulated trades, and there's, it's great. It's just awesome when you see members helping each other out, independent of me. Obviously, people who got questions with interactive brokers, been using it for 20 odd years. I can definitely help you with IB, but other people use different brokers. Sometimes they don't know how to do something. Put the question in the chat. Someone's going to answer, help you out. It's awesome. So class schedule. So we meet on a Wednesday. So same time as today, but just Wednesday. So at the moment, 7 p.m. New York time every week. So yeah, like I said, we've been meeting every week since January 2017. Every now and then I'll take a week off, but not that often. Usually just Christmas, but I probably won't take a week off this year. I don't think we're going away anywhere. Yeah, do go on vacation occasionally, so I might not do, might have a couple of weeks off a year, but basically it's every week. So Thursday, 11 a.m. Melbourne time, which is New York, 7 p.m. at the moment. And then that switches to 8 p.m. in the American summertime, just because of daylight savings. All right, any other questions? Is Interactive Brokers one of your recommended options trading platforms? Yep. And certainly if you're new and you're going to join the group, I would recommend IB because that's the one that I'll be demonstrating all the trades in, and that's the one I can help you out with the most. But IB, Think or Swim second, and then maybe like a TradeStation third in terms of recommended brokers. But typically you're going to want to be with either IB or Think or Swim. So yeah, just a question on the schedules. The modules are all pre-recorded, so you just get access to those straight away with your login and password. Go through them in your own time, and then the weekly schedule is every Wednesday night, 7 p.m. New York time. All right. Any other questions? All right. Seems like everyone's good. If you think of any questions later on, feel free to email. Otherwise, enjoy the rest of your evening or your day if you're over this side of the world. And we'll talk again soon. Okay. Thanks, everyone, and take care.